Welcome to the Money Answer Show with host Jordan Goodman. Whether you are starting out, deep into your retirement, or somewhere in between, the Money Answer Show has the know-how to help you. Now here's your host, Jordan Goodman.
Welcome to the Money Answer Show. This is Jordan Goodman, your host. My guest for the first half hour is Greg Elisara. He is head of brand and communications at Harmoney, which is a lending platform based in New Zealand and Australia. Welcome to the show, Greg.
Hey, Jordan. Nice to be talking to you.
Just a little bit of history of you before we get to what Harmoney has been about.
Sounds good. Yeah, so look, I have a long history in digital product design, to be honest. So I go back about 15, 20 years and have spent a lot of time building products, spent much of my time in advertising, and then actually was working with Harmoney before they launched in 2014. I spent 6 months working with them, getting prepared for their launch, which was very successful. And then 6 months after that, on the back of a capital raising round, they offered me to come and join them. So I started off as their very first head of product design and was in that role for the last 4 years. And most recently, have been offered and have started in the role of head of brand and communications. But I've been, very involved with the company. We started off as a small team in a small office, and have grown steadily over the years. We now have over 120 people, and in the context of that, New Zealand, that's a relatively decent-sized company here, especially for a FinTech. And so my involvement in the business has really put me in a good position to be able to take over this role of brand and communications. And that's where I am today.
Great. So let's talk about the kind of FinTech world a little bit. There's all kinds of new startups like yours that are coming into the area. Your particular area is, I guess, what's called peer-to-peer lending. What role do you play that traditional banks are not playing? Or how can you disrupt traditional banks?
Yeah, well, it helps to have a little bit of context of the New Zealand situation. We're a very small country. On the other side of the world, we're somewhat work very closely or seen as associated with Australia. They're very much the big brother, and New Zealand is a much smaller marketplace, and so we have to a certain extent relied heavily on Australian banks. In fact, in New Zealand we have 4 major banks. I know in the US, for example, you have thousands of banks, so there's lots of choice, and there's lots of options for customers. In New Zealand, historically, we've been pretty well dominated by the 4 major Australian banks, who are some of the most profitable banks in the world. We do have challenger banks in New Zealand as well, but what that does provide to us is this massive opportunity to create opportunities for borrowers and lenders in New Zealand, and that's kind of where we fit in. We are able to use innovations and technology to create new products and services for those customers who, to a certain extent, aren't getting the same level of service from those large incumbents. So that provides opportunity for us, and that's kind of where we fit in.
So let's take it first from the lender side, from people who need loans. Is it easier to get a loan from Harmoney, or is the interest rate lower? What is the advantage of getting a loan from Harmoney as opposed to going to one of those big 4 banks?
Yeah, exactly. Well, it's both those things, to be honest, Jordan. In the first instance, we provide a much more convenient way for borrowers to apply for a loan. So there's no having to book to go in to see someone at the bank. You can do it at any time at your own convenience on your own device. And for a lot of people, that's a big deal. If you go into a shopping mall, for example, in New Zealand on the weekend, and we have lots of banks who have their branches in those malls, there are just scores and scores of people in those banks trying to get service on a weekend because they cannot get away from their jobs during the week. So just the pure convenience of being able to apply from anywhere at any time is a big deal for those people. The second thing is we make that application very, very quick. So most people can get an application done, in less than 10, 15 minutes. That's 10, 15 minutes out of their day at any time they choose to do it. And for a lot of people, let's face it, it'll be late at night when all the kids are in bed and stuff. The other thing too is that New Zealand has been experiencing some of the lowest interest rates in historic times, to be honest. They've never been lower. And really up until, we kind of came onto the market in 2014, 2015, we weren't really seeing the benefits of lower interest rates come through into personal loans for consumers. Now, it may just be timing, but, we like to think that, part of our introduction into the marketplace with risk-based pricing, which for some borrowers provided them with a much, much lower rate, really did put pressure on those interest rates to come down across the whole board. So when they come to us, they get risk-based pricing, which they don't get at a bank. It's pretty much one size fits all if you go to a bank. And that means that people can get very good rates for us based on
how much lower would the rate be for a borrower from Harmoney versus a traditional bank for the same kind of loan?
Yeah, so banks, they traditionally will sit somewhere at around 18 to 20% per annum for a personal loan. And it's been that for many, many years. And everyone pretty much gets the same rate if you go to one of the main banks. If you come to Harmoney, we have a wide range of interest rates based upon credit profiles, and they'll go anywhere from being 8.99% up until your 29.99. But of course, when you get into those higher interest rates, they really are for people who really don't have a credit history, and therefore we're just giving them an opportunity to kind of create that history with a very, very small loan in many cases. But for those low interest rates, when you're on 8.99, for example, and we offer up to $70,000 for some of our borrowers in those instances, you can have significant savings, especially if you're comparing that with a comparable bank loan, which could be around 18, to 20%.
Wow. And now let's go to the other side. For the savers, what kind of yield can they get, and how does that compare to what they can get on savings accounts at the four traditional banks?
Yeah, so in New Zealand, we've the most common investment vehicle for retail lenders, and they're really your Ma and Pa investors. They would be putting their money into what we call term deposits. I think over there in the US they're called
savings accounts, or CDs. Yeah.
CDs, yeah. So over here in New Zealand, if you put your money into a CD, you'll be getting 3 to 4%. And if you put your money into Harmoney, for example, and invest in loans, we are seeing our retail investors are seeing returns of upwards of 12%. So that is a significant increase and increase in return for those investors. And of course, one thing that also we've been provided to the marketplace in New Zealand is just the ability to get into an asset class which they've never had availability to before. We know that banks have really benefited from being able to secure the personal loans marketplace for decades and decades and decades. That hasn't really been available to Ma and Pa investors, and so with them coming on to the Harmoney platform, this is really the first time that they've been able to enjoy the returns that you can get from that asset class.
And what have been the bank's reaction? They don't like competition like this. They're losing out on both ends. They're losing their deposit accounts and they're losing loans to you. What has been their reaction to that?
The reaction has been actually what we've seen from the banks in New Zealand has actually been really quite positive. They know that the world is changing. They know that there are things that there are certain products and services that they will need to look at in the future but to a certain extent, they have got some time to just sit back and observe of what is happening. And so what we've seen is banks looking very closely at what FinTech can provide to consumers. A lot of them have invested into their own incubators to explore this space. And we are also seeing them, partner up with FinTechs. And we are an example of that. So we have on our platform institutional lenders, and some of those are banks in New Zealand who have come onto the platform, and we are also partnering up with the Australian bank as well. So what we're actually seeing them is kind of embracing where we're going with FinTech, but they are kind of working through partnerships rather than going in, wholesale. And we just see that as being really positive. I believe that there are many, many opportunities for us to work together for the benefit of borrowers and lenders.
And so do you get the word out about what Harmoney is offering pretty much online, or how are you marketing the brand?
Yeah, that's right, Jordan. It's pretty much online. We really do focus on getting our digital channels working most effectively for us. We have done some other, marketing for example, New Zealand's a little bit unusual, being such a small marketplace. It is possible for you to almost get nationwide reach through television nowadays. And if you're in Australia, certainly in the US, you could never dream of doing that. But in New Zealand, it's still possible. So we still do some television marketing, but predominantly it is through digital. And so, we do a lot of the normal digital activities. But we work very closely with partners in the digital space. One of those being Google, who we work with very, very closely.
Very good. We're going to take a break. This is Jordan Goodman of the Money Answer Show. My guest this half hour is Greg Elisara. He is head of brand and communications at Harmoney, which is a peer-to-peer lending platform based in New Zealand. They also have operations in Australia. We'll be back after this.
We're always talking business. Talk to an expert. Call now toll free 866-472-5790. That's 866-472-5790. Voice America Business Network.
Many industries have been revolutionized by technology in the last decade. Books, music, TV, communications, and now it's happening to our money and the way we pay. Tune in to Breaking Banks with Brett King for a look at how technology and customer behavior will bring about more changes in banking in the next 10 years than in the last 200 years. Listen every Thursday at 3 p.m. Eastern Time, noon Pacific on Voice America Business Channel or on AM 1160 The Voice. You'll never look at your bank account the same again.
Attention heroes, current and former firefighters, law enforcement, military, medical, or educational professionals. Heroes can receive rewards averaging over $2,500 when they buy, sell, or refinance a home. Heroes come first. Along with the Homes for Heroes is the nation's largest hero reward program. Their mission is to provide extraordinary savings to heroes who provide extraordinary services to our nation and its communities every day. Learn how you can purchase a home for no down payment, no closing costs, and get money back at closing. Find out how you can own for less than you may pay for rent. Get your hero rewards at heroescomefirst.com. That's heroes, HEROES, comefirst.com. 888-437-6114. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
We're always talking business. Talk to an expert. Call now, toll free, 866-472-5790. That's 866-472-5790. Voice America Business Network.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this half hour is Greg Elisara. He's head of brand and communications at Harmoney, which is a peer-to-peer lending platform based in New Zealand. And you also work in Australia, is that correct? Are you going to have big hopes for growth in Australia? Yeah,
we do. We do operate in Australia. We launched quietly in Australia in 2015. We were still very much focused on growth in New Zealand, but Australia has always been part of our plan. And so our launch there in 2015 was really, more than anything, was to just understand the market a bit better there, and also to prove out the product would work there and work effectively, which that has proven to be. And so in the next year or two, you'll see us start to develop more in Australia and to make a bit more noise in that market space as well.
So how many other peer-to-peer lending platforms are there in New Zealand and Australia competing with you?
There's a number of, there's quite a few small operators in New Zealand. So in New Zealand, you have to have a license to operate a peer-to-peer marketplace. In New Zealand, I think we're a little bit unusual globally in that the New Zealand government specifically made legislation to support peer-to-peer lending in New Zealand. And that was because they saw the opportunities for us to be able to create innovation in New Zealand, and that we needed a strong regulatory framework to be able to support that. And so we have 4 license holders in New Zealand. We were the first in 2014 to get issued with a license, and we are, I think it's safe to say that we are by far the biggest in New Zealand, with now over $1 billion in lending. In Australia, there's a few more players and a few more established players. We certainly weren't the first in Australia, but we are now the fastest growing platform in Australia, and we certainly aim to be one of the biggest there as well.
So how would you compare what you do to the big players in the U.S., particularly Prosper and Lending Club, which are really getting quite large, although they've had some definite issues? I mean, they've had higher default rates than most people expected, and there were some regulatory issues. How do you compare where you are with Prosper and Lending Club?
Yeah, well, one thing that I think is key to understand when we think about comparisons is just really the size of our market. It is very small in comparison, and so when you're working in a smaller marketplace, you do have a certain level of exposure where you really are dealing in a much smaller pool of customers. And so you'll find that we are very, very focused on understanding customers and what their needs are, and not just in one individual product. Currently, yes, we just do personal loans, but we are looking at other opportunities to provide other products and services, and that may extend, well, we expect that would extend out of personal loans at some point. And the other thing that we keep in mind too is that at any one time, we have many customers who we cannot offer a personal loan to at that time. And so what we do is we are looking at opportunities to be able to provide value to those customers, which may be beyond a personal loan. It may be some products that are around managing their credit score, for example, or it may be around savings, or it may be a product that enables them to learn more just about financial education. But when they come to us, yes, they may be coming for a personal loan, but depending on their circumstances, a personal loan might not be the right answer for them at that time. And what we'll be looking for is ways that we can provide value to them beyond that personal loan. In terms of what other competitors are doing and what some of the larger players are doing, because of the size of their markets, they probably don't have to really have those same levels of consideration. Yes, they'll be focused on providing superior user experience and customer experience, but they probably don't have to diversify into products and services as much as we do with a smaller customer base.
Yeah. What kind of default rates are you experiencing on the lending side? And is this something that the savers, the people who are investing, are happy with, or are they having higher default rates than they might expect?
Well, when talking about default rates, we do fold that into what we call our realized annual return for a portfolio, and those are all published on our website. I mean, one of the key principles of Harmoney right from when we started was to ensure that we shared as much data as we could with lenders. And indeed, a large part of our license is for us to be able to share this information with lenders. Of course, they need to be able to make an informed credit decision when they're investing in a loan. So we do publish all that information on our website. And what we're finding from lenders is that they accept that there will be losses. That's just part of being a lender on a platform. It is part of the risk when you take on a loan. But with these return rates of north of 12%, it's a risk that they're willing to accept. I guess the key thing for our lenders is really the biggest challenge for us is just getting enough loans to be able to service the lenders that we have, but they're certainly happy with the returns, and we get very, very little negative feedback around losses.
So in the imbalance right now, there's more people wanting to lend money than there are people willing to borrow, or what is the balance like between those two?
Yeah, that's right, Jordan. We have 9,000 active lenders on our platform. And that's really where our challenge is just being able to get the growth to be able to service those lenders. We have much more money to lend than we have borrowers at this point.
So would you expand in Australia or other places as well to get more borrowers?
Yeah, indeed. So, a large part of our focus will be Australia in the upcoming years. That's a big marketplace for us. There's certainly some challenges there, some exciting ones though. Like often it works the other way. You'll have an Australian company who gets large and established in Australia, and then they'll come over to New Zealand, and then they'll start to grow their market share by going into New Zealand. We're kind of doing the reverse thing. So we're small, a small market, but we're large here. Our challenge is to make an impact in Australia. And we feel that we have the product to be able to do so, and it's a much larger market. So we feel as if we can, just make a solid entry into that marketplace over there. Then we expect real positive outcomes from that.
Can you take money from anywhere? Can somebody from the U.S. invest in Harmoney as well online? No, unfortunately. We'd love to be able to take funds from offshore, but no. At the moment, you do need to be a registered investor in New Zealand. There's actually it's actually more of a compliance issue for those types of lenders than anything else. We would certainly be happy to take those funds, but there is AML or anti-money laundering compliance that we have to adhere to, and that often requires people to be residents in New Zealand. I see. Just talk a little bit briefly about the kind of personal finance education efforts going on in New Zealand, because I think there's quite a few of them from the government. What are some of the initiatives in that area?
Yeah. Look, that's a really interesting question. New Zealand has over the last 10 years or so spent a lot of money or effort, educating New Zealanders in personal finance. A lot of that has come through government funding of various tools, online tools, and online documentation and information. And there's good reason for us doing that at a government level. Our household debt, has reached extraordinary levels. We have it's now at a high of 166% of gross income. We have things like, for example, a seaside city called Tauranga in New Zealand, which when I was growing up was something of a sleepy seaside surf town, and has grown to be New Zealand's second largest city, and has become the 8th most unaffordable city in the world in which to live. And so New Zealand has unusual challenges to a certain extent, and a lot of that comes down to being able to understand personal finance. And so the government has spent a lot of effort into creating tools to be able to foster an understanding of how best manage personal finances. From our perspective as a company, we feel that still there's a lot of work to do here. It's one thing to be able to provide tools online and information to be able to try and encourage education, but I think we need to do. We need to do a lot more. Certainly in a lot of the applications that we see, we do see a disparity or disconnect between people's understanding of personal finance and their own situation. Just doing more tools and providing more documentation, I'm not sure that's the answer. I think we need to have a look at how we can actually change the experience of maybe even applying for a loan, or looking at the way that people understand or comprehend their credit score, so that they can learn what all these things mean. There's really this kind of disconnect between what the principles are and what actually happens and plays out in real life. And I think that's where we need to make improvements. Very good.
Well, thanks so much. My guest this half hour has been Greg Elisara. He's the head of brand and communications at Harmoney, which is spelled Harmoney, which is the biggest peer-to-peer lending platform based in New Zealand, but also going to Australia. And I guess the website, Greg, that people can find out more is harmoney.nz.co, is that, or the other way around?
Just about, it's the other way around. So it's Harmoney, harmoney.co.nz.
Very good. Terrific. Well, thanks so much, Greg. Appreciate you being on the Money Answer Show. We're going to take a break now, and we're going to come back in the next half hour with Ola Dantis.
Stocks, bonds, investment opportunities, financial news, and talk. We can help. Call us now toll free, 866-472-5790. 866-472-5790. Voice America Business Network.
Do you or someone you love have a life insurance policy that's no longer needed or not affordable? Did you know that you can sell your policy for cash? Your reason for buying life insurance has probably changed. Thousands of Americans turn to life insurance settlements to help sell their policies. They act as your representative, getting the highest market offer for you. You've got nothing to lose by simply inquiring. If you're over 64 with $100,000 or more of life insurance, you may already qualify. Call 877-485-6681 to get your free non-binding appraisal, or visit fundinglife.com. Life Insurance Settlements. Discover the true value of your life insurance. 877-485-6681. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
The Voice America Live Events channel is here now to showcase your corporate, individual, or organization's live event. Visit voiceamerica.com/live events to see all of our past live events and find out more. Whether it's a multi-day conference, special speaker, or single-day event, we've got everything to make your event a success. We can do a few hours or a few days. For more information about taking your event to the next level, call Jeff Spinard at 480-294-6417 or email info@voiceamerica.com. Again, that's Jeff Spinard at 480-294-6417 or send us an email to info@voiceamerica.com. Voice America is where you are and where you want to be. Join us around the globe as we broadcast live from some of the most interesting events available. Don't forget to view all our live events, including on-demand access to past events that you may have missed by visiting voiceamerica.com/live events.
You've been listening to The Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to The Money Answer Show. This is Jordan Goodman, your host. My guest for this half hour is Ola Dantis. He is the founder and CEO of Dwellin.com, which is a multifamily investment syndication firm based in Baltimore. He's also the anchor on the podcast called Dwellin. Welcome to the Money Answer Show, Ola.
Thank you so much for having me, Jordan. I'm really honored to be on your show today.
So just give us a brief history of how you got to where you are and how you kind of got into real estate.
Yeah, sure. So, I've been living a pretty good life. Here in the United States, I was going to my 9-to-5 job and, living in a comfortable apartment building with my wife. And life was great. But I just felt like there was something missing, like something I could not explain, right? And then kind of a long story short, I read this book called Rich Dad, Poor Dad. And just, after reading that book, I just had this epiphany of like, wow, I could actually do much more with my life. And then obviously real estate was one of the strategies I was talked about in that book. So that kind of just, turned a light switch in my mind of I could actually live a way better life instead of me just paying somebody cash flow. I was going to be receiving cash flow for my assets in real estate. So that's kind of like a really brief, introduction of myself. We are Dwellin. We get properties, on the contract. We invest with other syndicators. We invest with, some of our clients, and then we take down bigger apartment syndication deals, which I can go into in detail.
Yeah. So let's start with your first deal. You have a 9-to-5 job. Just tell us briefly how you made the transition and what the first deal you made and a little bit about that.
Yeah, sure. I typically like to tell a story, actually, how that kind of came about. So, like I said, I was living in the United States, and I've obviously lived in the UK as well. So my colleague called me from the UK and said, "Hey, Ola, can you meet me in Dubai?" I was like, "Wait, what?" He's like, "Yeah, can you meet me in Dubai? I'm going to be meeting with some investors there. I want you to meet me there, and I want you to help me with my business." So I did, what every smart man does. I asked my wife and said, "Hey, baby, a friend of mine, that obviously she knows, said I should meet him in Dubai." And she's like, "Well, absolutely not. You can just pick up the phone, do a Skype call, FaceTime, Zoom. You've got so many technologies. You don't have to actually go there in person." So I told my wife, I was like, well, maybe if I go, maybe I can learn something about his business and that might maybe help us. So eventually she did allow me to go. So I was on my way, jumped on the plane, went to Dubai. It wasn't like a fancy trip. We were just basically locked in a hotel room for about 3 days, just masterminding and kind of helping him with his business. But as that was going on, I realized that, wow, he was doing so well in his business in the United Kingdom in real estate. I was like, wow, I can do the same thing or similar when I get back home to the US. So when I got back home, I started listening to podcasts. I picked up a lot of books, one of which was, Rich Dad, Poor Dad. I started educating myself about real estate, and then I kind of narrowed it down to, starting with multifamily, right? So multifamily, let's say small multifamily, these are basically, 2 to 4 units, typically under one roof. So what I did was, about 6 months after I got back from Dubai, I had this fire burning in me. So I started looking at properties. I started analyzing, buildings, and I started to, teach myself on the different parameters to look at, on the different metrics to look at when I'm analyzing these deals. So eventually we got down to this one building. I like to say it is in a Class A area in Baltimore, Maryland. So we bought our first building, and, a little bit of just a short story. My wife just, randomly one day, I think we were just sitting around, and she was just like, "Hey, baby, I feel like I'm having a lot of money in my account these days." I was like, "Yeah, me too." And that was, a few months after we actually moved into our building. So we were living in one of the units in the building. So we started getting, rent paid to us, as opposed to what we were doing before, which was paying somebody else's rent and obviously giving them cash flow. So that epiphany was kind of like the start of our journey. Like, wow, what if you can do, another one? And what if you could do another one? And, that kind of started our journey. We created our company, Dwellin.com, to basically buy bigger apartments and share the profits with other investors.
So what is the advantage of doing multifamily, as you say, 2 to 4 family homes versus single family homes for investors?
That is a fantastic question, Jordan. So if you, for example, you're thinking, I want to get started in real estate, and then you just go out there and you buy a single family, which is great. There's one of two ways you can do it. Is you can basically buy a single family, and if you want to be somewhat passive, you can basically give that asset to a property management company, and they would basically manage the thing for you, right? So you don't have to really worry about, toilets or whatever, right? That company will manage for you, and they will obviously they charge, typically between 4 to 8%, depending on where you are in the country, and then they manage all that for you, and they give you, the spread of cash flow every month. Or you can buy the single family and then manage it yourself. Then you have to deal with the tenants. You have to understand, tenancy laws in your market, wherever you are in the United States. You have to basically deal with other people. But this is the kicker. When your tenant moves out, you have 100% vacancy on that property. So you have to pay the mortgage during the month that you have to get another tenant in there. On the flip side, if you have a two unit a duplex, or 3 unit a triplex, or a 4 unit a quadplex, depending on where you are in the country, if a tenant moves out, you still have another tenant paying for that mortgage. So you're not paying a lot of money while you're waiting to fill the units in. So if you have a 4 unit, for example, if somebody moves out, then you have, obviously just 75% occupied. So you're still fine. That would cover most, if not all, of your mortgage. So you don't have to worry about, paying for that extra, expense every month, essentially. So I think that's the one, major difference between sort of a single family and a small multifamily. I mean, there's other reasons, but that's just the main one.
Do you recommend only staying in your local area where you live, or do you recommend investing in properties elsewhere in the country where you don't live, which it's going to be more remote?
So there's a lot of debate on this in the real estate investing sphere. And what I say is it all depends on you. If you feel like you're comfortable with owning properties out of state, then you should do it. But if you feel like you want to be very active in terms of managing your assets, and you want to be able to touch and see and talk to your tenants and just really have your property in your backyard, you can. There isn't a right or wrong way. However, if you're just want to be on the passive side, you can invest in an apartment building in Texas, and you've never ever seen it, right? The only thing you're going to see is your monthly checks or your quarterly disbursement checks, right? You don't actually have to see the actual building. It's just like some of us, we have our 9-to-5 jobs, and you have a 401k and maybe IRA. You never really see or been to the corporate headquarters of the stocks that you have. You've never ever been to Facebook or Twitter maybe. So you don't really have to necessarily see your asset for you to invest. So I think for you to have a great opportunity nationwide, I tend to advise folks to just, make sure when you invest to just invest in first and foremost in the person. So obviously myself, like an apartment syndicator, multifamily syndicator, and the deal, right? And maybe the market. So as opposed to if it's close to me or, if it's not close to me, that's for the most part, as a passive investor, it's not really relevant.
So in looking to buy properties, are you looking for things that are on the market or things that are not on the market, and you're approaching somebody to sell who may not even be thinking about selling?
Yeah, so that's a fantastic question. So from an investor's perspective, we like to look for off-market deals. So we typically tend to reach out to brokers in a specific market, in this case Texas, and we basically tell them what we're looking for. We give them a criteria, 100+ unit apartment. We want in this particular submarket. If you do find something, let us know. So typically we build this relationship with the brokers over a number of months, and then when they find something, they are more than happy before it gets to the public market to send it to us, and then we can underwrite the deal, see if it meets our criteria, and then we basically take that deal down, close that deal, and obviously now start to raise equity and send it to our investor base.
So this is not something the average individual is going to be able to do. And you're talking about 100-unit apartments, not 2 and 4-unit apartments, kind of big syndications.
Correct. Yeah. So let's kind of go back down to the 2 to 4s. So if you're, somebody who has kind of started listening to podcasts, you've started reading about real estate, or maybe you get a coach to help you learn a little bit more, you're thinking, hey, instead of me flipping or instead of me buying just one single, family resident, I want to go multifamily 2 to 4. So that is definitely, public information. You can go on Realtor.com, Trulia, Zillow, and you can just basically go to the filter and just choose multifamily, and then you can start to see those duplexes all the way to quads in your market, right? And just kind of add to this, if you're looking to start small, and if it's your very first property, you can actually qualify for an FHA loan, which is basically something that will allow you to put down, 3.5% as opposed to 20% down on a particular home. So that's really good for those who are thinking of just starting out. So you can just buy, a 4-unit in your market. You live in one and then you rent the others. So basically, the others basically pay for your mortgage while you live rent free. I think that's the main advantage.
Do you always need to have good credit to do this? I mean, what if you don't have great credit? Can you still get into the real estate game in small apartments?
Oh, well, absolutely. Yeah. This is, I don't want to get, really into the details of, your credit score, but essentially, if you can get a mortgage on a 4-plex or a triplex or a duplex, you should be able to get in. And also, if you don't want to buy apartments, but you do want to get in and you feel like maybe you don't have enough cash to start with, or maybe you think your credit is not too great, you can do, real estate has a lot of different strategies. You can do wholesaling, which is essentially you basically reach out to sellers, some of which could be out of state, and you basically try to get a property under contract from that particular seller. And then you find an investor, typically a flipper or maybe a buy and hold investor, and basically sell that property on. So you're basically like a middleman, and then you get that spread, that arbitrage in the middle. So that's another strategy that a lot of people tend to start with in the real estate investing game.
I guess they call that wholesaling typically, right?
Correct.
Yeah, very good. Okay, we're going to take a break. This is Jordan Goodman of the Money Answer Show. My guest this half hour is Ola Dantis. He is the founder and CEO of Dwellynn. And you can see more about him at his website, Dwellynn.com, which is spelled DWELLYNN.com. He also does a podcast about real estate called Dwellynn. We'll be back after this.
From the boardroom to you, Voice America Business Network.
Are you a homeowner tired of making monthly mortgage payments with little progress towards paying down your principal? Does paying off your home in 5 to 7 years without making larger or more frequent payments sound appealing? Paying off your home in full in 5 to 7 years is really possible thanks to Truth and Equity's Mortgage Equity Optimization System, a money management approach that puts your money to work for you 24/7. If you own a home with some equity, have a decent credit score, and verifiable income, you owe it to yourself to learn more about Truth and Equity's program. There's no need to replace your mortgage or refinance in many cases. The system works for new home purchases as well as current mortgages. Your home is your largest investment. Own it outright in 5 to 7 years. Call Truth and Equity 888-262-5540 or visit truthandequity.com 888-262-5540. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Ola Dantis. He is the founder and CEO of Dwellynn.com, which is a multifamily investment syndication firm based in Baltimore. Welcome back to the show, Ola.
Thank you so much.
So let's talk a little bit about the advantages, the tax advantages particularly, of investing in real estate.
Yeah, absolutely. So I'm kind of going to walk through, just the different advantages. So one is cash flow, right? And, for someone hearing this for the first time, they might go, what is cash flow? So cash flow is essentially, the remaining amount of money you get at the end of the month after you've paid, for your, what we call PT, so property, taxes, insurance, your mortgage, and some folks even advise you to put some money into some sort of escrow account for just maintenance. So basically everything after your mortgage, your taxes, your insurance has all been paid for, and obviously excluding maintenance, what you keep, right? So that's cash flow. So that's one advantage. Second advantage is appreciation, right? So we could buy an apartment building, or even you could buy a small multifamily property and put it under your portfolio for X amount of money. Easy maths, let's say 200,000, and maybe in 5 years is appreciated, which is the same thing for your single family as well. But that's the good thing about real estate, that property can increase in value, and then you can, in some cases, pull out your initial funds that you deployed in that asset. That's the second thing. Third thing is also, taxes, right? You can't go wrong. I think there was a news, I think a few months back, that Jared Kushner had, made like so much money but paid zero in taxes. And the reason why that is because with real estate, especially commercial real estate, there's something called depreciation, right? You can basically depreciate the value of that asset and make that an expense pretty much in your taxes. So that expense wipes out a lot, if not most, of your income. So what you have as taxable income dramatically reduces, right? So, you can just pay on that taxable income, which most of which has been wiped off by depreciation. In terms of taxes as well, there's something called a cost seg, which is a cost segregation study. This can be done on larger assets as well, where you get a consultant, goes through the apartment, and it breaks down the apartment down to even palm trees outside, right? And basically that can also help to reduce your taxes. Now, you might be thinking, well, I'm not sure how this works. Well, if you join one of our syndications, or if you invest with somebody that buys bigger commercial assets, typically you would join the LLC that owns the property. So when you get your K1 at the end of the year, which is basically your summary of your investments, that would show up on your K1. That expense would show up. So in turn, that would roll over to your personal taxes, and then you can basically get those tax incentives. Now, I must say, I'm not a tax advisor. Always, reach out to your tax advisor, your accountant, if you want to find more about some of these terms that I've referred to on the show.
Let's talk about syndication specifically, and even a deal you have now. How much does it cost for people to invest in it? What kind of yield are they going to get, and what kind of appreciation should people expect them? How long are they expected to hold on to a piece of that syndication?
Sure. So because of, different regulations, 506B and 506C, I can't, say too specifically on this particular deal, but I can give you an idea. So for example, we have a deal we're looking at. To invest with us, the minimum investment is $50,000. Also, you have to be an accredited investor. You can check on our sites to see exactly what that means. So you would invest. So in a typical deal, I don't want to put a name. Let's just say a typical deal. Our returns could be between 12 to 15% in terms of yield, or cash on cash return, as we call it. But sometimes, in the past, some of the deals have actually gone up so much in terms of appreciation because we, paint, fix, renovate a lot of the units within the apartment building. And when we go to sell in 5 to 7 years, it's gone up tremendously in terms of appreciation. So not only as an investor, not only are you going to be getting monthly or quarterly checks in the mail coming to you, when we sell, you also split in the profits as well. So you get a big payout at the end of the life of the investment as well. So that's kind of like the overview.
Okay. And what is the advantage of doing a syndication as opposed to doing it yourself, buying a 2 to 4 apartment, syndication yourself?
That's a great question. So, going back to the mode of investing, if you want to be an active investor, or you're thinking of maybe scaling your business from starting small and then kind of graduating up into larger assets, and you think that you have the bandwidth, you have the time, and then you have the knowledge to go out and take down a deal then, yeah, sure, do that. And you obviously learn a ton. I would advise to speak to someone like myself, or maybe get a coach, just kind of walk you through, because real estate is a very, very, very complicated business. So just know what you're doing. On the other side, however, if you feel like you just want, to maybe just get someone, you just write a check and they deal with all the complexities, then obviously I refer you to maybe checking out like our website and just basically go in the passive mode of investing. You don't want to be the one speaking, to the property management, managing the asset. You don't want anything to do with that. You just simply write a check. So is it that you want to be on the passive side of investing, or you want to be on the active side? Now, there's also a major difference if you're looking to buy a duplex, depending on where you are in the country, that could be $150,000 to buy that. So you can obviously raise that capital from, by yourself, maybe by saving up, or, maybe getting help from your family or whatever. But if you want to buy a 100-unit apartment building, you're looking at about $5 to $10 million, depending on where you are in the country, right? So know a lot of people have 20% of $5 million laying around, like $1 million to go buy 100-unit plus apartment building. So that's why we do syndications. And I know it's a very fancy, big name, but basically syndications just means that you come together with other people to take down an asset, in this case, real estate asset, that you can't take down by yourself. I'll give you a real life example real quickly. If you're flying somewhere in the country, let's say you're flying to Florida, you don't call up United and say, hey, United, can I buy one of your planes, and I'm going by myself? You buy a ticket on a plane and you basically share the cost of that plane ride from where you are to Florida with 300 other people on the plane. So that's the same thing with syndications. Yeah.
What is the risk of buying into a very hot market like a San Francisco or Seattle if you want to do it as an investment?
Oh, yeah. So we definitely tell our clients and, folks that reach out to us when they talk about, maybe New York City and California, some of these very hot markets, you could lose some money in terms of your monthly cash flows, because some of these hot markets is just really, really difficult to find assets, particularly in the multifamily space, to find assets that actually make sense and you can really make good on your returns to in this case, our investors. So we stay clear of those markets because you could be in serious hot water if you don't know what you're doing and you're buying multifamily in some of these very, very hot markets.
Yeah. So you tend to buy them when there's not as much competition and you can get a better price that way. Is that what you're saying?
Correct. And we buy in select markets. So we really like Texas. There's a lot of growth potential in Texas. There's a lot of population and there's a lot of just, general market drivers that we look at Dwelling to help us select those markets and to, keep active in those markets.
Tell us briefly about your podcast. What kind of things do you have on your podcast, Dwelling?
Yeah, thank you so much. So the Dwelling Show has been on for quite some time now. We have amazing guests who would basically come and share their story of kind of how they got started to inspire folks who are thinking of real estate. Maybe they're tired of the stock market, the up and down of the stock market, and they may be thinking of getting into real estate investing, either as a passive investor, somebody that you just want to write a check and just get someone to manage it, or as an active investor. So for us, we're targeting folks who are kind of in the beginning stages of their real estate investing journey, and we just basically give them free knowledge and just train them of how to spot failures in the market and how to win in this market.
And then do you act as a mentor to people who want to learn about real estate as well?
Currently, we're working on a program in-house here. So if folks are interested in kind of working with me, they can, obviously go check out our site. You can go to investwithola.com to kind of learn more. And if you just want to, work with me.
Terrific. Very good. Well, we've covered a lot of ground. My guest this half hour has been Ola Dantis. He is the founder and CEO of Dwellyn.com. That's spelled DWELLYNN.com. You can see the syndications he's doing, the podcast he's doing about real estate. So I guess you've made quite a success of yourself, Ola, starting just by reading a book.
Yeah, I'm so thankful. I'm so grateful to be a guest today. Thank you so much.
Thanks so much. We'll be back again with another edition of the Money Answer Show next week. Goodbye for now.
Thank you for joining Jordan Goodman and the Money Answer Show. If you have a question for Jordan, please visit his website at www.moneyanswers.com. And be sure to tune in every Monday at 12 p.m. Pacific Standard Time right here on Voice America Business. See you next week.